Have you ever sat in front of the chart, knowing FOMC was about to release in 10 minutes, and felt your hand drift toward the buy button before the announcement? You weren't trading the chart anymore. You were trading the anticipation. The number released. The market moved. You took a position. Within 30 seconds, the move reversed. Within 5 minutes, you were out at a meaningful loss. You didn't have a thesis for that trade. You had a feeling about the news. And the market punished you for it. If this has happened to you, you've experienced news reactivity. And today, we're going to break down exactly why even disciplined traders fall into it. Welcome back. This is episode 14 of the Perp Trading Psychology series, News Reactivity. We're 4 episodes into the second arc now. Tilt, drawdown, profit, taking, and now news. These 4 sit underneath the first arc surface patterns. They're the deeper structures that determine whether your discipline holds or breaks. And news events are where discipline breaks most reliably, even for traders who would never break it in normal conditions. This is not because news events are unpredictable. It's because news events activate a specific psychological pattern that most traders never train for. That pattern has a name: narrative trap. By the end of this episode, you'll know what it is, and how to either avoid news entirely or trade it deliberately. Never the fuzzy in between that destroys most retail accounts. Quick explanation for anyone hearing this term applied to trading. News reactivity is the pattern where a trader who would otherwise follow their plan abandons it temporarily during high impact news events. The trader is not technically untrained. They have a strategy. They know what to do. But the news event activates a state where the strategy feels insufficient. Like the news is bigger than the chart. So they take a position based on the news interpretation, not the setup. The position frequently goes against them, because news interpretation is one of the hardest games in finance, and most retail traders are bad at it. But the deeper pattern is, the trader's strategy didn't fail during the event. The trader walked away from the strategy. That's news reactivity. And it costs more accounts during quiet markets than people realize. Because the trader who breaks discipline once during news has now demonstrated to themselves that the strategy is breakable, and the breaking happens more easily next time. Let's start with the neuroscience. News events trigger a specific brain response called the salience network. The salience network is the part of your brain that identifies what's important in your environment. When something high stakes is happening, a loud noise, a sudden change, an unexpected event, the salience network activates and prioritizes that thing above everything else. In trading, news releases activate this network powerfully. The Fed announces, the CPI prints, a major political event unfolds. Your salience network screams that this is important. You must act. But the salience network doesn't tell you what to do. It just tells you to do something. Your prefrontal cortex is supposed to handle the what to do part. But under high salience, the prefrontal cortex gets overshadowed. So you end up with overwhelming pressure to act, weak ability to decide what to do, and a position taken on impulse. The position is rarely good, because impulse positions during high salience moments aren't trades. They're discharges of nervous energy. There's a specific pattern during news events called the narrative trap. It works like this. The news drops. Numbers come out. Within 5 seconds, every financial commentator on social media has an interpretation. This is bullish. This is bearish. This means the Fed will pause. This means the Fed will hike. You're scrolling through these interpretations rapidly, trying to figure out what the news really means. But here's the catch. The market isn't trading the news. The market is trading the consensus interpretation of the news. And by the time you've read enough takes to feel like you understand, the consensus has already priced in. The move has happened. The reversal has happened. You take your position based on the news interpretation. The market does the opposite. Because the market already moved on the actual data 30 seconds before your interpretation finished forming. This is the narrative trap. You're trading your understanding of the news, not the market's behavior in response to the news. Those are two different things, and the retail trader cannot reliably distinguish them in real time. The pro knows this, so the pro either doesn't trade news or has a very specific, predetermined process for trading the volatility, not the interpretation. There's a second pattern worth knowing. The pre-news positioning trap. Some traders try to outsmart the narrative trap by positioning before the news. The thinking is, if I take a position 30 minutes before FOMC, based on my prediction of what the Fed will do, I'll catch the move before everyone else. This sometimes works. Mostly it doesn't. Because pre-news positioning requires you to be right about two things simultaneously. 1, your prediction of the news content. 2, how the market will interpret the news content. Even if you nail the first, the second is unpredictable. The Fed announces dovish numbers. You're long. The market sells off because participants thought it would be even more dovish. You were right about the news, wrong about the reaction. Pre-news positioning has a worse expected value than most setups in your normal strategy, because you're betting on a coupled probability when one alone would already be hard. Pros who position pre-news do it with full understanding of the asymmetry. Most retail traders who do it haven't thought through the math. Let me describe 3 specific patterns of news reactivity. The first pattern. The early release impulse. Important data drops. Within 3 seconds of the print, you've taken a position. You haven't analyzed anything. You've just reacted. Your nervous system felt the salience and discharged it through an order. The trade is almost never good, because 3 seconds is not enough time for any analysis, and the move you're chasing is usually already mostly done. This pattern is most common in inflation prints, employment numbers, and earnings releases. The pro waits, sometimes for hours, until the immediate noise has cleared and a real structural read is possible. The retail trader trades the noise and gets noise back. The second pattern, the catch-up panic. You miss the news. You see the move already happening. You feel like you need to be in it. You take a position in the direction of the move at the moment of maximum extension. This is FOMO with a news label. The move you're chasing usually reverses partially or fully within the next 30 minutes. You exit at a loss. The move continues in the original direction without you. The catch-up panic captures the worst possible price, then exits at the worst possible price. It's a double loss in a single trade. The third pattern, the thesis sticking after invalidation. You took a position based on your interpretation of the news. The price moves against you. Your stop is being approached, but you can't accept that your interpretation was wrong. The news, in your mind, is still bullish, or still bearish. So you remove the stop, or you add to the position. The position goes further against you. This pattern combines news reactivity with hopium. And it's the most expensive pattern in this category, because it converts a small reactive loss into a portfolio damaging event. The trader who removes a stop because they can't let go of their news interpretation has stopped being a trader for the duration of that position. They've become a commentator with capital at risk. There's a cultural amplifier specific to crypto and perp trading, the macro narrative obsession. In crypto, every macro event is treated as if it determines the entire future of the asset class. A single tweet from a politician, a single Fed comment, a single regulatory announcement. Crypto Twitter explodes with takes. Everyone has an opinion. Everyone is sure their interpretation is correct. A trader sitting in this environment can't help but absorb the narrative pressure. Even if you have a chart-based strategy that has nothing to do with macro, you start to feel like ignoring macro is irresponsible. So you start trading macro badly because you weren't trained for it. The pro who's primarily a chart trader knows this trap. They explicitly tune out macro discussions during news cycles. They protect their strategy from contamination by narrative. The retail trader stays plugged in and takes a few macro-driven positions per month that don't fit their strategy and don't make money. Over a year, those few positions are usually the difference between a profitable and unprofitable year. There's a pattern that hits sophisticated traders specifically. The expert trap. The more you've studied macro, the more you feel obligated to have an opinion on every release. You've read the books. You follow the right analysts. You understand the framework. And so when the news drops, you feel like a fraud if you don't act. Acting feels like applying your knowledge. Sitting still feels like wasting it. But your knowledge is not the issue. The market's responsiveness to your knowledge is the issue. You can be exactly right about the macro picture and still lose on a news trade because the market is trading something else in the short term. Positioning, options expiry, liquidity dynamics. The expert trap pushes you to trade because you understand. The discipline is, understanding is not a signal to trade. Understanding is what makes you patient enough not to trade. Pros who have the most macro knowledge often trade news events the least. They've learned that knowing what should happen is different from knowing what will happen in the next 30 minutes. The retail trader with less knowledge trades more news. The pro with more knowledge trades less. The relationship is inverse. There's a leverage angle worth knowing. News events combined with leverage are particularly dangerous. The volatility around news releases on perps can be extreme. Wicks of 3-5% in a single minute are common around major events. If your stop is too tight, you get wicked out and the price returns to its trajectory without you. If your stop is too wide, the wick takes out a significant portion of your account. There's no good stop placement around news events on perps, unless you've designed your strategy specifically around these events with knowledge of the typical wick distributions. Most retail perp traders haven't, so they put their normal stops on, and the news event wicks them out. Then they're flat for the actual move. Pro perp traders who trade news events typically either close before the event and re-enter after, or significantly widen stops and reduce sizing to handle the wicks. The trader who does neither keeps normal sizing, keeps normal stops, and stays in for the event usually gets the worst of both worlds. So how do you build news discipline? I'll give you 3 practical rules. 1. Decide your event policy in writing before the event. For each high-impact event type, Fed, CPI, employment, earnings, major political, write down your default behavior. I do not trade in the 30 minutes before or after Fed. I close existing positions 1 hour before earnings. I do not initiate new positions in the 24 hours after major political news. The specifics depend on your strategy. The writing is what matters. When the event approaches, you look at your written rule. You execute it. No real-time decisions during high salience moments. 2. Mute news sources during your active trading hours. This sounds extreme. It works. If your strategy is chart-based, news sources during trading hours are a contamination risk, not a value add. You can read news after the session. You can monitor major events through a calendar app that doesn't expose you to commentary. But scrolling crypto Twitter or financial news during your trading session actively damages your decision quality. Pros who run chart-based strategies do this routinely. They're not uninformed. They just consume news on a different schedule than they trade. 3. Practice the do-nothing muscle around events. When news drops, your default action should be do nothing for at least 15 minutes. Watch the chart. Don't take positions. Let the dust settle. If after 15 minutes a setup that matches your strategy has formed, then you can take it. But most of the time, no setup forms. The volatility was just volatility, not structure. The trader who can do nothing for 15 minutes after major news has unlocked a discipline that most never develop. That 15 minutes is the difference between trading the chart and trading the noise. There's a flip side worth knowing. Professional traders who deliberately trade news events have a very specific approach. They don't trade the interpretation. They trade the volatility. What this means? They have predetermined rules for how the market typically behaves in the minutes after major events. They position to capture the volatility patterns, not the directional interpretation. For example, they might have a rule that says after FOMC, the initial 30-minute move is often reversed within 4 hours. So they fade the initial move with predetermined size and predetermined stops. This is a strategy with back-tested parameters, with known expected value. It looks nothing like the retail trader's news trading, which is pure interpretation chasing. If you want to trade news events successfully, you have to do it the pro way. Predetermined rules, back-tested parameters, strict execution, or you have to not trade news events at all. Either is fine. The fuzzy in between. Sometimes trading, sometimes not, based on how you feel, is what destroys retail accounts. The discipline is to choose one and stay in it. So, to summarize today's episode, news reactivity is the pattern where traders abandon their strategy during high-impact news events. It's driven by the salience network in your brain, which prioritizes high-stakes moments above careful analysis. It traps you in the narrative trap, trading interpretations instead of the market's actual response. It manifests as early release impulses, catch-up panics, and thesis sticking after invalidation. It's culturally amplified by macro-narrative obsession in crypto. And on Perps, it's structurally amplified by the extreme volatility wicks around major events. The 3 practical rules: write your event policy in advance, mute news sources during active trading, and practice the do-nothing muscle for 15 minutes after major releases. Underneath all of it is the realization that news doesn't move markets. Interpretations of news move markets. And the gap between when the news drops and when the consensus interpretation prices is too short for retail traders to operate in profitably. The pro accepts this. They either trade news the pro way, predetermined volatility plays, or they don't trade news at all. The retail trader keeps trying to trade interpretations and keeps paying. In the final episode of this arc, we're going to talk about what happens when tilt, drawdown, news reactivity, and the entire psychological infrastructure of trading finally breaks down. Burnout recovery. The trader who overtraded for months, who took too many losses with too much intensity, who eventually went quiet without quitting. The silent quit, the identity collapse, and the rebuild, what it looks like, how long it takes, and what comes out the other side. Appreciate you all for listening. If this episode helped you, subscribe and share with someone who keeps trading the news and keeps losing money on it. And I'll see you guys in episode 15. Start trading now on Mosey Finance. Trade perps everywhere with one dashboard. Link in bio.